Hello and welcome back to Debit Credit Done, the podcast that makes accounting simple, practical and totally passable. I'm your host Dean Quartermain and this is episode 7 of our second series on the AAT Level 3 unit, Financial Accounting, Preparing Financial Statements. Before we dive into today's episode, just a quick apology from myself for the delay in releasing this episode. This is due to some events in my personal life which meant I wasn't able to record the episodes on time. But hopefully we're going to get back on track and help to continue to build your knowledge step by step. I just want to say thank you for sticking with me. It's much appreciated. So in episode 6, we focused on inventory valuations, covering the FIFO and AVCO methods and looking at the rules around IAS 2. We also set a challenge, so we're going to start today's episode by just reviewing the answers to the challenge before we dive into today's content. So a review of the episode 6 challenge then. So the challenge was related to inventory valuations, working out cost of sales, closing inventory valuation at cost, and then doing a net realisable value check to work out whether or not we need to adjust the closing inventory based on the rules around IS2. So what we had was we purchased on the 1st of June 200 units at £4 each, total cost £800. 8th of June we purchased a further 100 units at £5 each, total cost £500. And then on 15th of June we sold 250 units. And we're told that the net realisable value of the remaining units is £4.20. So what we need to do then, firstly, work out cost of sales. Remember, cost of sales under FIFO, we're just going to take first in, first out. So it's 250 units, so we're going to start with the ones we purchased on the 1st of June, 200 of those. So we want all of those, the total cost for all of that. And then we want another 50 units out of the purchase on the 8th of June. So 100 units, £5 each, £500. We want half of those, so £250. 50 at £5. So the total cost of sales is £1,050. We then want to work out what's the closing inventory at cost. Well, the closing inventory in this case, we've got 50 items left from the purchase on the 8th of June at £5 each. 50 times 5, £250. So at cost, closing inventory is valued at £250. Final thing we want to do is to work out whether it's the net realisable value affects the closing inventory valuation. So we're told that the net realisable value of the remaining units is £4.20. So we get the calculator out. 50 times £4.20, 210. That's less than the cost, so we should use the net realisable value. Overall impact of all of that is the statement of profit or loss is going to show cost of sales, £1,050. And the statement of financial position is going to show the closing inventory has been valued at £210. Now, if none of that makes sense, I recommend looking back at episode 6 and then re-looking at the challenge. You can also reach out to me on social medias. I'm on Facebook, LinkedIn, all the social channels. You can reach out to me if you've got any questions. So what are we going to cover in today's episode then? Well, we're going to cover two things that you've already learned. So we're going to combine two topics, depreciation and disposals. Now we've done episodes on both depreciation and disposals separately. What we're going to look at here is combining the two things together. So we're going to look at why AAT often combines the topics into one question. We'll look at a reliable step-by-step approach to depreciation and disposal questions. A full works example. My example, straight line, prorated with a cash sale. We're going to then mix it up a little bit and twist it by saying, well, what happens if there's a part exchange instead of a cash sale? And then we're going to look at some exam tips to help secure as many marks as we can when we look at the question, the exam questions. So firstly, why combine depreciation and disposal? Well, let's just jump back to the real world for a minute, out of the theoretical AAT world into the real world. Yeah, in the real world, assets are used. Yeah, so a fancy word for used is depreciated. Yeah, and then they're eventually sold or part exchanged or scrapped. So in the exam, you're often going to see combination questions because that's more reflective of the real world. That might ask you to do things like calculate depreciation up to the date of disposal, transfer the cost and accumulated depreciation into a disposals account, record the proceeds, whether that's cash or a part exchange trading allowance, and determine the profit or loss on disposal and then post that correctly. That's very typical of the sort of thing you're going to be asked to do. Yeah, and it's testing whether you can apply multiple skills in sequence. Yeah, so can you calculate depreciation? Can you then post those entries? Yeah. Can you now dispose of the asset knowing what you need to do for disposal? And then can you post profit or loss on disposal into the relevant accounts? Yeah, can you calculate the profit or loss correctly? And it's almost pulling all the skills together around depreciation and disposals into one scenario, one question. Now, it is a step-by-step approach in order to do this. So if you've got a question that's asking you about depreciation and disposals, step-by-step approach that I suggest would be to calculate depreciation to the date of disposal. And when doing that, make sure you respect whatever the depreciation policy is. So is it straight line? Is it reducing balance? Are there any pro rata requirements in either the year of acquisition or the year of disposal? Make sure that you respect whatever that policy is. Then transfer the cost of the asset. So we're going to transfer the cost of the asset, debit disposals, credit the asset account. Transfer the accumulated depreciation. So debit accumulated depreciation, credit disposals. And then record the proceeds. Now, for a cash sale, that's simply going to be debit bank or cash, credit disposals. And for part exchange, we'll come on to in a little while. Just explain. We've done that previously, but we'll re-explain that in a little while. And then you need to balance the fifth step in the process. Really is to balance the disposals account and post the profit, or the loss. So profit, credit, profit and loss, debit, the profit and loss account, depending on whether you've made a profit or loss on disposal. So let's look at a quick example then. So what we've got is a machine. Yeah, so I don't know, we own a factory, bought a machine for £20,000 on 1st of January 20x0. Company's depreciation policy, straight line, 5 years, no residual value. And prorated in both the year of acquisition or the year of purchase and the year of disposal. And then we sold it 31st of March 20x2 for £9,500 in cash. So remember, step 1, depreciation to the date of disposal. Now this question could be more difficult because reducing balance makes it more difficult. This is straight line. There's no residual value, 5 years. So the cost is £20,000, 5 years, £4,000 per year depreciation. So in 20x0, we had it for the entire year. So we've got £4,000 worth of depreciation for year 1. 20x1, we had it for the whole year. So again, the same amount. Yeah, depreciation £20,000. Depreciation £4,000. Cost is $20,000. 5 years. Yeah, so the annual depreciation £4,000. So we've got £4,000 for year 1, £4,000 for year 2. Year 3, bit more complicated because we didn't have it for the whole year. We only had it from January to the end of March, 3 months. Yep, so it's the £4,000 the annual depreciation, and we want a quarter of that, £1,000. So the total accumulated depreciation to the date of disposal is £9,000. The carrying amount at the date of at disposal is the carrying amount. Remember, cost minus accumulated depreciation. Cost £20,000. Accumulated depreciation £9,000. Therefore, carrying amount at disposal £11,000. Once we've got all that, then we can do the disposal account entries. So we're going to transfer the cost. Debit disposals, credit machinery for £20,000. We're going to transfer the accumulated depreciation. So debit accumulated depreciation, £9,000. Credit disposals, £9,000. And then we're going to record the proceeds. So debit bank, £9,500. Credit disposals, £9,500. So now we've worked out depreciation to the disposal date. We posted the disposal account entries. We now need to balance our disposals account. Now, hopefully, when you do this, you'll draw out a T account. That's exactly what I'd recommend you do. Doing that, you'll see debit side, £20,000. Credit side, the £20,000 related to the cost that you've moved into the disposals account. Credit side, you'll have £9,000 relating to the accumulated depreciation and £9,500 relating to the proceeds. You can now hopefully see that the debit side's higher than the credit side, so you need to balance it. So £1,500 on the credit side of disposals, which means you've got a loss on disposal. Yep. Post a loss on disposal to the profit and loss account. So debit, loss on disposal. A statement of profit or loss, £1,500. Credit, disposals, £1,500. Yeah. The overall result of all of that then is the asset and the accumulated depreciation have been removed, and the statement of profit or loss shows a £1,500 loss relating to the disposal of that asset. Now that's if you're using cash. Now, as we mentioned when we looked at this, people don't usually sell assets and not replace them. Quite often, we sell our car and we get another car, don't we? We part exchange our car, we get an allowance for that, and we get another car in exchange. So it's exactly the same idea, just a different flow around the proceeds. Yeah. So instead of cash, then the dealer offers £9,500 trading against a new machine that costs £25,000. So first thing we're going to do is dispose the old machine. So as per the second step above, so the second step was, so you're still going to have to work out your depreciation to the disposal date. You're still going to post your transfer the cost. You're still going to transfer the accumulated depreciation. However, when you're recording the proceeds, the proceeds will, the entry for the proceeds, instead of it going debit, bank, credit, disposals, it's going to be debit, the new asset, for £9,500, credit, disposals, because that allowance that you're getting, it's not going in your bank account, it's been used to part pay for the new asset. So you're going to debit the new asset, £9,500, credit, disposals, £9,500. And then the other thing that changes is you now need to record the new machine at full cost. So you're going to debit £15,500, which is the balancing amount of the new machine. You're going to post that to machinery, and you're going to credit bank or payables for the £15,500 that you've actually got to pay, which is the difference between the full value of the asset and the part exchange allowance. So the difference, obviously you've got to pay that somehow, either bank or from payables. You balance the disposals account as before, you've still got a £1,500 loss. The golden rule, however, is to make sure that the asset is recorded at full cost. Right, next thing then, some exam tips. So my tips for these sort of combined scenarios, first thing I would say is do your depreciation first. So update your accumulated depreciation to the date of disposal. Yeah, do that first before you do anything else. Ensure that you've read any requirements around pro-ratering of depreciation. Yeah. Be very careful about what it says on both purchase and disposal. So you may have a mid-year purchase of the asset, and it may say full year's depreciation in year purchase, so you need to follow that. Equally, you might have a mid-year disposal, in which case normally you'd pro-rata it, but it may say full year's depreciation in year of disposal. Just follow whatever the depreciation policy says. Make sure you use the disposals account. So make sure the entries are going out of cost and out of accumulated depreciation into disposals. Make sure that the other side of your part exchange or the other side of your disposal proceeds is recorded into the disposals account. Make sure you identify what the disposals proceeds are. So are they cash or is it a part exchange trading allowance? Make sure you show, ideally, draw it out. Yeah. So you've got all your workings, so you can check where it's right and where it's wrong. And then a good sign to make sure things are right is if proceeds are greater than the carrying amount, then you've got a profit on disposal. Yeah. If proceeds are less than the carrying amount, you've got a loss on disposal. That's always a good sort of sanity check to make sure that when you're recording your loss or your profit or your loss on disposal, that you've got it right. So just as a recap then of what we've looked at today, so we've covered why depreciation and disposals are combined within AAT questions. So we've explained a little bit around why that's the case. It's more reflective of real world scenarios. We've looked at a clean and repeatable 5-step approach for these sort of questions. Walked through a full cash sale example with the £9,500 proceeds, which resulted in a loss on disposal of £1,500. We've looked at how you adapt those entries for part exchange and looked at some key exam tips that hopefully will help you just pick up those extra few marks. So hopefully the next episode's going to be out on Thursday. And I've got a bit of a challenge before that episode. So the challenge I'm going to set today then is a business buys machinery for £20,000 in January 20X1. Company's depreciation policy straight line, 5 years, no residual value, pro-rated in both year of purchase and year of disposal. And we sold a machine on the 30th of September 20X3 for £9,500 in cash. So what I'd like you to do, calculate depreciation for each year up to the disposal date, show all disposal account entries, and then calculate profit or loss on disposal and state the impact on the statement of profit or loss. So that's it then for episode 7 of Debit Credit Done. In episode 8, we're going to move on to looking at control accounts, and specifically the sales ledger control account and the purchase ledger control account, and how they reconcile with the list of balances from the subsidiary accounts. Until then, keep practicing, keep reflecting, and remember, debit, credit, done.